What if a company had Indonesia's #1 cooking oil brand, a near-zero net debt balance sheet, a growing dividend, and still traded at less than half its book value? That's not a typo. Less than half. Today we're doing a full deep dive on Indofood Agri Resources, ticker 5JS on the Singapore Exchange, and I'm going to walk you through exactly what I found after reading 6 years of annual reports. By the end of this video, you'll know what this company actually does, why it's interesting right now, what the real risks are, and most importantly, what price I'd actually buy it at. Let's get into it. So here's the simple version. IndoAgri is basically a farm-to-table business, but at industrial scale. They grow oil palm trees on about 280,000 hectares of land in Indonesia. That's roughly the size of Luxembourg. The trees produce what's called fresh fruit bunches, FFBs. Those go into 27 palm oil mills that squeeze out crude palm oil, CPO. And here's where it gets interesting. Unlike most plantation companies who just sell the CPO as a raw commodity, IndoAgri owns 5 refineries that turn that CPO into something you'd actually recognize on a supermarket shelf. Biodiesel, Indonesia's #1 cooking oil brand. If you've ever cooked anything in Indonesia, there's a good chance you've used Biodiesel. And there's another business most people miss, the seed genetics unit. Landmine has been selling DNA-optimized oil palm seeds commercially, and in 2025 they sold 11.1 million seeds. That's up 88% since 2021. High margin, fast-growing, completely underappreciated by the market. That full chain, from genetics to consumer brand, is what makes IndoAgri structurally different from a pure plantation play. So what protects this business? I see 4 moats. First, distribution network. Strong. Indofood's 1,300-plus stock points across 17,000 Indonesian islands. Took decades and billions of dollars to build. Almost impossible to replicate. Second, brand equity. Biodiesel has been Indonesia's #1 cooking oil brand for decades. That brand enables price pass-through even when commodity costs spike. Third, vertical integration. Moderate moat. The full chain from seed to consumer creates a natural hedge. When CPO prices fall, the downstream refining margin expands. The two sides of the business partially offset each other. Fourth, seed genetics. Narrow but growing. Their DNA marker technology cuts the oil palm breeding cycle from 12 years down to 6. That's a genuine R&D edge in a capital-intensive industry. So why are we looking at this now? 2 words, biodiesel mandate. Indonesia has a government policy that mandates a certain percentage of palm oil in every liter of diesel fuel sold in the country. In 2023, it was be 30% palm oil. In 2024, they pushed it to be 35. In 2025, be 40. And they're gunning for be 50, half of every diesel liter in Indonesia being palm oil. That's not a rumor. That's stated government policy. Why does this matter for IndoAgri? Because it creates an enormous structural demand floor for CPO. Even if global edible oil supply is abundant, Indonesia is mandating domestic absorption of 14 million tons a year and climbing to 14.2 million kiloliters of B40. This is why CPO prices in 2024 and 2025 traded at their largest premium to soybean oil in decades. That's not a coincidence. That's policy-driven demand. Now add 2 more things on top of the biodiesel tailwind. CPO prices have recovered hard. From a 2023 trough of around $972 per ton, prices recovered to $1,100 in 2024 and $1,283 in 2025. The CPO chart tells the story of the supercycle, the normalization, and the policy-driven recovery. And here's the growth kicker. IndoAgri just completed a major refinery expansion in November 2025, a 3rd production line at their Tanjung Priok plant in Jakarta. That adds 450,000 tons of refining capacity per year, a 30% increase on their previous number. More CPO converted into branded Biodiesel products instead of being sold as raw commodity. Combined with the debt story, which I'll get to in a moment, you have a structural demand tailwind, a new growth asset, and a much cleaner balance sheet all arriving at the same time. This chart is the one I keep coming back to. In 2020, IndoAgri had 8.9 trillion Indonesian rupiah in net debt. That's a serious debt load for a company of this size. Management spent the next 5 years paying it down methodically, consistently, without doing flashy acquisitions or distracting M&A. By the end of 2025, 628 billion Indonesian rupiah. Net debt to EBITDA of just 0.12 times. For context, a reading below 3x is considered safe. They're at 0.12. The balance sheet is essentially clean. That decision, to prioritize debt repayment over growth, is a sign of disciplined capital allocation. And now that the debt is gone, the question is what they do with the free cash flow next. I went through 6 years of annual reports, 2020 to 2025. Here's what the numbers tell you. Revenue in 2025 was 21 trillion Indonesian rupiah, up 32% from 2024. Net profit attributable to shareholders, 1.27 trillion Indonesian rupiah, up 14%. EPS, 910 rupiah per share. But here's the important context. The 2021 and 2022 numbers were inflated by the CPO supercycle. Palm oil hit record prices after the Ukraine war disrupted global vegetable oil markets. Then 2023 was a rough year as prices normalized. The 2024 and 2025 recovery is genuine, driven by volume growth and price support from the biodiesel mandate. The net debt line tells the real story. From 8,910 billion Indonesian rupiah in 2020 down to 628 billion Indonesian rupiah in 2025. That trajectory is exceptional. Now, let me give you the 5 things that actually move IndoAgri's earnings. CPO price is the biggest lever. A 10% move changes net profit by roughly 500 to 700 billion Indonesian rupiah. It's the single most important variable to watch. FFB production volumes, how much fruit the trees produce, is the second driver. This has been held back by the aging tree issue, which I'll cover in the risk section. Refinery utilization. The Tanjung Priok Line 3 expansion means more capacity to convert CPO into branded products at higher margins. Branded product mix. The more Moly sells relative to bulk CPO, the higher the blended margin. NC genetics revenue. Small today, but growing at 88% over 4 years. Watch this one. EBIT margin in 2025 was 17.6%, down from the 20.3% peak in 2024 as revenue mix shifted. But the direction of the underlying business is improving. Now, I don't do hype, so let's talk about what could go wrong, because there are real risks here. CPO price decline high. A 10% price fall hits net profit by 500 to 700 billion Indonesian rupiah. The 2026 consensus is for softer prices in 2025. I'm modeling earnings down about 20% in 2026 before recovering. Aging tree profile high. About 35% of IndoAgri's nucleus oil palms are over 20 years old. Older trees produce less fruit. That's been a structural drag on production volumes since 2018. The company is replanting, but replanted trees take 4 years to produce. This headwind doesn't fully resolve until 2027 or 2028. B50 policy delay medium. Indonesia actually vacillated on the B50 timeline in Q1 2026. A delay reduces the CPO demand floor in the near term. This is a real watch item. Related party transactions medium. The Salim Group does over 8 trillion Indonesian rupiah in annual transactions with IndoAgri. Sales, purchases, loans, guarantees. That's about 40% of consolidated revenue flowing through related party channels. The transactions are disclosed in arm's length per SGX rules, but the scale means minority investors need to trust the governance framework. Brazil JV loss, low. The CMA joint venture in Brazil took a 178 billion Indonesian rupiah loss in 2025 due to the sugar price collapse. The Busola subsidiary entered negative equity. It's contained, but it's ugly. None of these are deal breakers for me, but they're the reasons IndoAgri trades at a discount and why I demand a proper margin of safety before buying. There's one specific item in the 2025 annual report I need to highlight, because I don't think the market is pricing it properly. Under other non-current assets, There's a line that jumped from 1.3 trillion Indonesian rupiah in FI 2024 to 3.4 trillion Indonesian rupiah in FI 2025. That's a 167% increase in 1 year. The explanation in the annual report? Forestry administrative charges, which were deferred pending the outcome of an appeal. That's 2.1 trillion Indonesian rupiah sitting on the balance sheet that could disappear if they lose that legal appeal. Roughly a 14% hit to book value in a single year. I don't know the outcome of that appeal. And frankly, the disclosure is so vague that the market probably doesn't either. This is not necessarily a fraud signal. These kinds of regulatory disputes happen regularly in Indonesian forestry, but investors deserve much more disclosure than they're getting. It's the single largest accounting uncertainty in the FI 2025 report, and I factor it into my risk analysis. All right, let's talk valuation. This is my favorite part. First, let's look at how IndoAgri stacks up against its peers. IndoAgri currently trades at about 7.3x trailing PE and 0.46x book value. Malaysian plantation peers, Sime Darby, KLK, IOI, trade at 20 to 25 times earnings. Even the more comparable SGX-listed peers, like First Resources, trade at 8 to 10x. Now, IndoAgri deserves a discount. It's smaller, less liquid, has governance complexity, and has the aging tree issue. But 7.3x versus a peer group averaging 10 to 15x? That feels excessive. Applying a conservative 4 to 5x EV/EBIT multiple, appropriate for this quality tier, gives me a multiples base range of 47 cents to 59 cents. The second method is a DCF, specifically a Buffett-style owner earnings DCF. I calculated owner earnings. That's net income plus depreciation minus maintenance capex, at about 242 million Singapore dollars for 2025. Per share, that's about 17 cents. I applied a discount rate of 10.2%, which accounts for the Singapore base rate, an equity risk premium, and an Indonesia-specific risk add-on of 1.5%, terminal growth rate of 2.5%. The result across 3 scenarios. Bear case. CPO prices fall back to 2023 lows for an extended period, 33 cents per share. Base case. Moderate CPO recovery, B50 partial implementation, 51 cents per share. Bull case. Full B50 rollout, production recovery from replanting, 72 cents per share. Weighted by probability, I land at 51 cents as my central DCF estimate. Putting both methods together, DCF midpoint, 51 cents. Multiples base midpoint, 52 cents. These two methods agree very closely, which gives me high confidence in the number. Blended fair value, 0.515 Singapore dollars per share. Current price as of March 2026, 0.395 Singapore dollars. That's a 23.3% discount to my fair value estimate. In my framework, the JC Fund framework, I require a 30% margin of safety for a full new position. That means I'd want to pay no more than 36 cents to go all in. At 0.395 Singapore dollars, I get about 23%, which is enough to start a half position. Here's the question that I always ask when I see a stock trading at a big discount. What is the market actually pricing in? I did a reverse DCF at 0.395 Singapore dollars. Working backwards from the current price, the implied long-run growth rate is only about 2 to 3% per year. The market is treating IndoAgri like a zero-growth commodity business, giving zero credit for the biodiesel demand tailwind, the Tanjung Priok Refinery expansion, or the seed genetics business that's grown 88% in 4 years. That gap between what the market is pricing and what I think the business can deliver, that's the opportunity. My own EPS forecast for the next 5 years, built from the bottom up, using CPO price assumptions, production volume models, and the refinery expansion ramp. FI 2026E, 737 Indonesian rupiah. CPO price softer by 15%. Refinery volume ramp begins. FI 2027E, 809 Indonesian rupiah. CPO recovers 7%. FFB production improves as replanting matures. FI 2028E, 895 Indonesian rupiah. B50 demand lifts CPO floor. Full Tanjung Prai capacity. FI 2029E, 967 Indonesian Rupiah. Volume growth continues with moderate pricing. FI 2030E, 1,024 Indonesian Rupiah, steady state. Replanting program fully reflecting in yields. That is CAGR of about 8.6% per year from 2026 to 2030. Not explosive growth, but steady, commodity-backed earnings growth from a business trading at 7x earnings. These are JC Fund internal estimates, not broker consensus. Uncertainty is high. A 10% CPO move is roughly a 600 billion Indonesian Rupiah NPAT swing. IndoAgri is a pass, monitor. Half position justified now. It's a high-quality, vertically integrated franchise. The balance sheet is the cleanest it's been in a decade. The biodiesel mandate gives structural CPO demand support that the market is systematically underpricing. The refinery expansion adds a real growth asset. And the Anomaly brand, underpinned by Indofood's distribution, is a genuine moat. My action plan. Initiate a half position at current price around 0.395 Singapore dollars. Target a full position on a pullback to 36 cents or below. If you want to be more patient, there's a cash-secured put strategy at the 36-cent strike. Collect a premium while you wait to be assigned at your target price. There are 4 specific catalysts I'm watching. H1 2026, FI 2026 half-year results. This tests the CPO price softening thesis and shows whether the Tanjung Prai Line 3 is ramping EOF volume. Outcome, up or down depending on results. 2026 rolling. B50 biodiesel confirmation. Full B50 rollout adds 500 to 700 billion Indonesian Rupiah additional NPAT. If confirmed, my valuation jumps to 60 cents or above. Big upside. 2026 to 2027 Forestry appeal outcome. If IndoAgri loses, up to 2.1 trillion Indonesian Rupiah could be written off. A 14% book value hit. Monitor closely. Downside risk. 2027 AGM dividend policy announcement. This is the single biggest re-rating catalyst. Right now, IndoAgri pays out only 14% of earnings as dividends. If management commits to 30% or above, the yield goes from 2.5% to 5.5%, and the stock re-rates immediately. Big upside. 2026 to 2028. Nucleus FFB production recovery. As replanted areas mature, production volume should recover 15 to 20%. That's a 20 to 25% EBIT uplift. Structural and durable. Upside. That's my full breakdown of IndoAgri. 5JS on the Singapore Exchange. If you found this useful, and I want to be upfront, everything I share today comes from public annual reports, publicly available research, and my own analysis framework. This is not financial advice. Do your own due diligence. Every investor has a different situation and a different risk tolerance. If you want the full institutional grade research report, including the forensic accounting section, all 15 CEO questions I'd ask management, and a complete DCF model, it's linked in the description. If you're new here, this channel is about my journey to financial independence through intelligent long-term investing. I share real analysis on real stocks I'm actually looking at for the JC Fund. No fluff, no pump and dump, just the work. Like, subscribe, and I'll see you in the next one.